Hello, and welcome to the latest episode of Cannabis Unlocked. In this conversation, Ben Burstein, Corporate Development Manager at LeafLink, joins me, Jordan Euclid, founding partner at Key Investment Partners, to share his cannabis career and expertise. LeafLink is a marketplace and fintech company that connects cannabis brands and retailers across 30 US markets and is a portfolio company of Keys. Ben explains his fast track into mastering industry research and M&A as a sell-side analyst at Citi. Ben dives into the cannabis industry's biggest challenges, from the lack of institutional banking to poor inventory management and limited investor readiness. From there, Ben and I put a spotlight on market trends in states like Ohio and New York and reflect on LeafLink's role in automating compliance and sales through its new All Access initiative. The conversation wraps up by exploring the impact of gray market dynamics and the future of M&A for the ancillary cannabis sector. Please enjoy the episode. So, hello everyone, and welcome to the latest episode of Cannabis Unlocked. Today, I'm very excited to be joined by Ben Burstein, the corporate development manager of LeafLink. Ben, how are you doing today, man?
Everything's great. The weather in New York's finally getting nicer. We're just about the end of the MSO earnings season. So been a really great time and just thank you so much for having me on the show. I've been a big fan for a long time and I have a lot of respect for all you and Tibby and the team do for our space. So just really appreciate it. I'm happy to be on.
Well, I really appreciate that, Ben. Thank you for the kind words, and we really appreciate being invested in you and the LeafLink team and everything you guys have done to build the industry. We've been invested for about 2 years now, and have really enjoyed the partnership. And so, maybe just to kick things off, I would love to learn a little bit more about your history. Where did you grow up? Where did you go to school? How did you start your career, and then ultimately get involved in the wacky industry of cannabis?
Thanks for asking. Originally from Miami Beach, Florida. I went to Penn. I was a Wharton undergrad, graduating in 2021. Back in 2020, when COVID had kind of shut things down, moved all my classes online. I was very fortunate that one of my mentors worked for Tuatara Capital, and they had recently launched a SPAC to go bring one of the ancillary tech companies public. So I was able to work with them for a year. I loved that experience. The team at Tuatara is spectacular. From there, I went to City Equity Research, and from my cannabis experience, they had wanted me to prep an initiation on the space from. So I spent about a year at City preparing for how a large commercial bank would actually go into the space. Unfortunately, the regulations didn't really move the way that most had hoped in 2020, 21, and early 22. So I had left to LeafLink and have now been at LeafLink for 3 years. My main jobs as I manage our mergers and acquisitions and industry research functions internally. So I play a large part in the strategy that LeafLink has on taking part in the industry and really supporting operators. And I can't think of a better place to be. LeafLink is the wholesale platform for cannabis. We do a lot for the space. And just to give you an idea, across our two solutions, LeafLink and Leaf Trade, we help more than 3,000 brands sell product to over 8,000 dispensaries every single week. Almost 80% of all products sold at dispensaries across the country are originated on our platforms. We've facilitated nearly $10 billion in product sales over the last year. So I love the seat I have at LeafLink to play a role in hundreds and thousands of people's daily work. And really making it so that commerce in the space is more efficient, easier to manage, and overall just not as complex as some of the nuances in cannabis are for the industry.
Absolutely. Wow. So a lot of places we can take it, but one place I'd love to start is you think about uh, cities almost foray into cannabis, right? Like we've seen a lot of that type of dynamic, right? You see a group like Cowan get in and initiate coverage, and then they get acquired and pull out, right? Or a lot of the MSOs, when they initially went public, did have institutional shareholders that ultimately had to sell off when the Cole Memorandum was rescinded. And like you said, the federal guidelines didn't develop in that 2020, 2021 timeframe as we expected. So that's all to say, what's your outlook going forward for when those real big institutional banks take cannabis seriously again, and those institutional capital flows are actually able to access our asset class?
Yeah, I'd say there's two main prohibitors to more capital flowing into the space. The first is the lack of institutional presence because of federal illegality.
Mhm.
Most large institutional investors are not going to touch an industry that's federally illegal, period. It's just not worth the risk. So until we see big changes at the federal level in terms of rescheduling, and I'm not even sure if Schedule 3 is enough, like true descheduling and move to a legalization federally is what it probably takes most large institutions to get involved. I mean, from like Citi and some of the other large financial institutions' perspectives, in order to actually cover and support the industry, you need to have a viable commercial banking business, so enough deposits and revenues on the banking side in order to bring a sector public like that. The other side is from an investment banking perspective. Is there
Mhm.
enough private or public companies that are willing to do like large scale M&A and capital raising? And that just
Mhm.
doesn't really exist in cannabis today. You have an industry doing a little over $30 billion in total sales. I mean, it's the same as North America Starbucks, right? Like cannabis is a big industry for those involved, but relative to some of the large institutional players, it's very small.
Mhm.
That's issue number one. Issue number two is most operators today are just not running their companies very well. It's very challenging in the market dynamics, like intense price and margin compression are specifically impacting some of the largest public players who many institutions would look to capitalize. But it's even more extreme. I mean, across the industry today, like inventory management is the biggest challenge that operators are facing. And I don't think people understand the scale of the problem. Like in an industry doing a little over 30 billion in sales, companies are losing more than $10 billion of cash and profitability on an annual basis,
Wow.
specifically because of poor inventory management. It's a combination of overstocking. Stores have way too much inventory on hand. At LeafLink, we have very good insight into what products are moving like across the platforms. The average retailer that's on LeafLink, so almost all of them, is carrying 100 to 120 days of inventory. The average like C-store or grocery store or smoke shop is at like 20 to 30 days. So those extra almost 100 days at the 20 to 30% like real cost of capital in cannabis is like $7, $8 billion of additional working capital sitting on these companies' balance sheets. Like that is so expensive. It's billions of dollars of lost profits every year through combination discounting, liquidations, inventory that goes bad. It's just expensive to stock so much product. You also have stockouts, right? Like the heaviest
Mhm.
selling, most interesting products to consumers sell out on average at most dispensaries, and that's lost sales for those stores. So this combination of those two problems alone are billions and billions of dollars of profitability. So like at LeafLink, we do a lot of underwriting. We are one of the largest factors in the space. There were
Mhm.
points a few years ago, we were doing nearly $100 million of factoring on a monthly basis. And what we saw is out of hundreds and hundreds of companies that we underwrite on an annual basis, in just the last 1 year, we underwrote about 600 companies. Four of them return money to their bank account on a consistent basis. So like companies just are not
Wow.
profitable. They're not well positioned for investment dollars. And while some have been able to raise from some of the alternative lenders and smaller shops, it's been very difficult for most in the industry, especially on the plant touching side, to access capital. So when things were booming and people really excited about the opportunities, and like people were more willing to take a speculative position in a new emerging industry. Like in 2020 and 21, the industry raised $10 billion. Uh,
Mhm.
in the 4 years since, the industry has raised like $3 to $4 billion in total. So the total capital drop off is just really a combination of like deteriorating markets
Mhm.
and turning off of like that speculative story. But
Mhm.
then also operators just aren't positioning themselves for investor dollars, and the ones that are working successfully, whether it's in specific state markets or specific operators that have very good operational cadences, are able to raise money and are able to do so at low rates. So as more companies professionalize and standardize their processes and emerge from this like current cost structure that's so hard to escape from, I think things will get better and capital will open up, but nothing's really going to move today.
Yeah, that makes total sense. And you talked about that spread between plant touching and ancillary businesses in terms of access to capital. Do you expect that will be a meaningful benefit to ancillary businesses in the short to medium term?
Ancillary the ancillary businesses have benefited from not being plant touching. Like LeafLink is a great story, right? We've have large names on the cap table, you
Mhm.
included, who've been able to support us, and largely because we are not a plant touching entity. So if any large institution wants to have like a role in the cannabis industry, the ancillary place is where you want to play. But you still have the same dynamic where the customers have a very challenging market dynamic.
Mhm.
So for some operators like LeafLink, like we care about all of our customers and we're specifically driving to improve their profitability. Like that is the focus of our platform is to make our customers more profitable. That's a
Mhm.
great story, and one that we've been able to raise on. Most ancillary companies are not taking that position in the tech stack. So I think you'll see a lot more of companies coming together and becoming this like all-in-one comprehensive solution that has been like kind of the place where the industry has played over time, and those companies are then able to recapitalize. But I don't expect like most of the ancillary players today to be able to significantly increase how much they can raise.
Right. Totally. That makes sense. And like it seems like there's always that spread where there is still more access for ancillary, but they're still both very correlated, right? Like to your point, that drop off from the 2020, 2021 timeframe to the last few years where it's been nothing, like it's been a very significant impact on the ancillary folks as well, for sure. Now you touched on the challenges in the credit markets as well. And, even just talking about the public multi-state operators, you see several $1 billion worth of maturities coming up in the not too distant future. Certainly not that much capital or at least dry powder today in the market to refinance it out. So I'm curious, like, how do you expect that's going to shake out?
Oh, I think that there are assets that are available today for free. You have to assume the leases. There is no equity remaining in those assets, and the creditors are looking for someone to run the asset because they themselves don't want to take over the companies. At the same time, you could then renegotiate some of those leases, restructure some of the operations, and the companies like you can effectively get paid to take on assets. No one in the industry is actually going and doing it, right? Like you have some receivers who are attempting to restructure companies with huge debt maturities.
Mm-hmm.
The challenge is that you have to have money on the other side of those receiverships in order for the restructurings to actually work. And what we've seen from some of the large scale California receiverships, like a State House or a High Times, or most recently like Gold Flora, Parent Co.
Mm-hmm.
The debts on these companies are so large and so expensive that there's no real way to run the assets with the pricing that the market's giving you today. So I
Yeah.
don't think you're going to have like new players come in to buy the assets right now. It's going to happen over time. I think most of it has been the large operators don't have the ability to do large scale M&A for a few reasons. Equity pricing is really low. They don't want to
Mm-hmm.
issue more shares at their existing prices. It's just too dilutive to the existing base. In some of the larger states, with large MSO presences, you're already at certain license caps. So it's very difficult for existing operators to acquire those assets. And then there's limited scalability benefits across some of the newer markets, right? Like in many of the newer states, like New York or New Jersey or like a Maryland, most of the new licenses being issued are specifically not meant to be vertically integrated and are more focused on like your social equity, smaller type player, which I think overall is very good in terms of empowering the market. But from like a large scale M&A perspective is very challenging to do. Some of the more legacy markets are where I've seen a lot of the M&A focus. But at the same time, given current like pricing dynamics and continued oversupply, like there's a lot of consolidation still to come in many of those markets. And I think most of like the smart investors that have seen these cycles play out over the last decade and understand how flows are going to move, understand that more assets are going to become available tomorrow than today.
Mm-hmm.
So I think there's really interesting opportunities in the very mature markets like California, Oregon. Washington's a bit healthier, but some of your just
Mm-hmm.
more mature markets that have gone through the maturity cycle and are contending with $200, $300 pounds. But over time, like Oregon, for example, had more plants in the ground this harvest than last harvest. And
Hmm.
that's with more licenses going out. So until those trends really start to change and you're able to better balance your supply dynamics, I don't think most investors are willing to buy these assets at current prices. And many of the strategics don't have the ability or room to do M&A, especially with the existing debt they have. They can't acquire
Right.
new leases.
Wow. Crazy. Interesting times for sure. So you, as you mentioned earlier, you get to see about 80% of national wholesale transactions. As we know, because of the regulatory landscape, really each different state operates effectively as its own market. And so I'd be curious to get your thoughts on where you're seeing bright spots in the industry of late and which states are really taking off.
Yeah, I appreciate you asking me that, and I love talking and comparing and contrasting many of the state markets. I think to give some context for what I'm about to say, every single state has gone through roughly the same maturity curve from California all the way back in 96, with Colorado being the first state to legalize in 2014. And it typically looks like a state starting up as a medical market. You have no like production infrastructure and you have no retail infrastructure. And the focus in early stage markets is to build up as much production as you can and build up as much retail as you possibly can. And over time, those two inputs really impact your supply and demand dynamics in states. Like how much raw plant material do you have? It's your supply. How much retail accessibility do you have from both like an adult use and medical perspective, door density? Like if people have stores close to where they live, they're going to consume legally. If they don't, they're very likely to consume illicitly. So over time, as a market matures, you get more supply, people build out more production facility space, and you get more demand. You have more stores that are licensed. What we've seen across most markets so far, and you have 42 states that have a legal program, 25 of them have launched adult use already. Um, as you get to adult use and you continue to grow the number of licenses, you start to get capped out in terms of total sales. It's either from municipal bans causing the actual locations themselves to increasingly become more dense and cannibalize sales from one another. Price competitiveness causing pricing to fall at the retail level, making it undesirable to open up new licenses. At the same time as that retail demand starting to slow, the growth in your supply curve typically continues very aggressively. The marginal costs of production in cannabis, just like any other agricultural input, are very low. If you have a 100,000 square foot outdoor field and you plant 50,000 square feet, the cost to do another 10,000 square feet is like essentially zero, other
Mhm.
than the seeds and the labor required to extract that plant. So everyone's growing as much as they possibly can in most mature markets, and that's why you have such oversupplied conditions. So I think like when you think about the states compared to one another, a lot more of the inputs are on where they are in the maturity curve rather than what they're actually doing from like a regulatory and structure perspective. I'm not the first person to like think about this framework. Many of the regulators in some of the newer states understand very well exactly what's happening from like a supply
Mhm.
and demand perspective, and their goals are to make sure that the operators in their states can remain very healthy and continue doing very well. So overall, there's six markets today that are going to contribute most growth from a retail perspective and from a sales perspective over the next few years. It's New York, which after a couple of years of struggles has done a spectacular job of issuing licenses over the last year plus, right? Like January 24, we were sitting here, it was 20 million of monthly sales on about 100 stores. Today we're sitting here, it's over 120 million in monthly sales,
Wow.
over 300 stores. So that growth has been great. The state plans to issue 1,500 total retail licenses and more than 700 new upstream licenses, and is very focused on making sure that that balance between retail and supply stays like relatively in line. The average pound in New York is selling for about $2,000. That's very healthy margins for most of the brands in the state, so things are generally good. So I'm very excited about New York. New Jersey is doing an excellent job. You have about 250 dispensaries today. There are 800 that are conditionally approved, and most of those are going to come online. We talked about capital access. The average pound in Jersey is selling for over $3,000. Pricing at retail is very good. Investors are very happy to allocate dollars into the New Jersey channel. I'm very happy about that state. Ohio has been awesome. The new adult use licensing that started last summer doubled sales from about 40 to over 85 million monthly, and that's before before you have all these new licenses being issued, what I love about Ohio is they're issuing all of the new licenses to existing operators. So all of the existing retailers get another licenses, the large scale cultivators get multiple licenses, the smaller cultivators get an additional retail license. So in total, you'll have 350 new stores come on. The base today is about 120, and you're going to have 40 new grower processors. So Ohio is going to continue to grow with very healthy margins and with like a much more skewed demand base that's growing faster than supply function.
Mhm.
Maryland's an awesome state. You have 900 social equity licenses that are being issued. What I love about Maryland is they've allowed the social equity participants to directly enter into the legal adult use market that's built by the comprehensive licenses in that state. So you have operators who are coming in that already have product to sell with established brand presences and platforms with many of the large operators like Curio and their Far and Daughter franchise program. I think they do a great job of that. Illinois, you have all your new social equity licenses coming on. It's been a challenge over the last year plus, but there's been a lot of talks on new like state provided capital to those licenses. Maybe some of the large operators providing like terms to them so they're able to open. It's really just been like a upfront capital challenge for those. In Minnesota, licensing is going to
Mm.
happen at some point over the next few months. They have already guaranteed one license for every 12,000 people in the state. So you'll have over 500 retail licenses and a large assortment of brands. So those six states combined are going to do most of the growth in the market over the next several years. I think you're also going to get some license growth in Michigan. You're going to have continued licensing in Detroit, in Southwest Michigan by New Buffalo and like the Indiana border, and some more stores in the UP. So that should continue to grow total store access. And then in Florida, like Florida has just been very challenging for most of the MSOs because of the capacity challenges. When you have like million plus square foot facility spaces, you want to open up hundreds of stores to cannibalize all that product. So it's really hard from a retail perspective, but the margins remain really good. So you have those 22 new vertical licenses that were issued earlier this year. Some of those are starting to come on. So overall, I think those like eight states in total are almost all the growth that you'll get in the market over the next
Mm.
few years. Maybe you get some benefit from like a Pennsylvania going direct, but who even
Mhm.
knows what it would look like? And like with the state-run model, what does that look like? Maybe you get some changes to like a medical program in North Carolina. The new Texas medical program can be pretty beneficial to some of those operators, and you might get some changes to like the Mississippi program to get more medical access. But overall, what many of these newer states are doing is understanding, hey, like we need to make sure that pricing remains at a place that brands can thrive and survive in the state. We cannot have these huge collections challenges that many operators across the more mature markets have faced, and we need to very properly balance where these stores are locating because one of the reasons California is so challenged is you see about 1,000 stores across the state. 150 of them are in like a few square mile radius in downtown LA. You have a bunch in like the main San Francisco area. And then you have some like specific nodes where a lot of stores located in the state. More than two-thirds of the municipalities in California do not allow cannabis businesses. There are places where you're 150 miles from the nearest dispensary. So like pricing has collapsed so specifically at retail in those states because of the density dynamics, not necessarily anything to do with like the number of stores and the way they've laid out. And regulators have learned those lessons.
Makes total sense. And so, a couple questions came to mind as you were walking through those states in particular where you see all the growth coming. First, wanted to ask you about New Jersey. We were both out at MJ Unpacked in Atlantic City a couple weeks ago. I believe you spoke there as well, right?
Yeah, I did. Thank you.
Yeah, yeah. So maybe what did you tell the crowd at MJ Unpacked, and how did you feel uh, was the sentiment coming out of that conference?
Yeah, thank you for asking me. LeafLink's had a very interesting time in our roadmap and story. We're launching our new all access release, very specifically focused on how we can help operators with the way they run their businesses and simplify it overall. What I spend my time at NJ Unpack talking about was specifically what LeafLink does to help operators, because I think that messaging is really important. Look, we've spent 10 years figuring out exactly how to make life as easy as possible for business owners, and we do so across like two huge areas. The first that LeafLink really helps operators with is we automate painful tasks across compliance, order management, and sales. I don't think people understand how hard it is to actually run a Canvas business.
Hmm.
If you run a brand and you want to make just one sale of one SKU to one retailer, you need to touch metric 13 times to transfer all the different transfers across the different stages and facility rooms. You need to input your order details across a bunch of different systems, whether it's like your actual order management system, your compliance system, your ERP, your financial system. Like it's just a lot of places that numbers need to live. And then you actually have to get that order delivered, transferred, and paid. That's a huge amount of work. It's really hard to do that. What we at LeafLink do is we specifically automate all of those requirements. It's the most robust place for you to really centralize your orders, streamline the way you run the business, and eliminate a lot of the manual data entry requirements. What I love about LeafLink is how we make people's lives easier. We have the most comprehensive metric integration in the space, so we automatically pull and push your transfers and inventory across facilities, rooms, and counterparties.
Hmm.
We have dispensaries that discover product on our site. Each brand on LeafLink and LeafTrade, on average, received over $1 million of sales a year just in last year, specifically from retailers coming onto the platform, discovering their products and buying them. Like, I want to make that very clear. LeafLink sources over $1 million of sales for the average brand on the platform. Like that's so impactful to their daily business. It's more than a third of what the average brand is selling on the platform. Like we put a lot of work into making sure that brands can source new sales through our marketplace. Like it's
Hmm.
what we believe a core function of what we do. We have very robust order management tools. So we have live menus, the B2B CRM, off-platform order forms. Like I think we do a really good job of enabling sales teams. Because we move so much product across the platform, we have the best market data analytics, inventory management solutions. Like we make great use of the data. And then we've built out integrations with other technology systems to connect those disparate systems. So overall, we think that's really valuable to the operator. The second piece that I think LeafLink has a very good proposition for operators is our financial services.
Hmm.
I'm very happy about our acquisition of Dama Financial back last summer. They were the largest banking provider in the space, and they've now lived at LeafLink for the last year. And our focus is really on bringing together the financial and commerce workflows so that the same places you place your order or make your orders, you have directly tied with your financial services system. So you know exactly how many dollars are coming in and out of the door. You have a direct AR and AP reconciliation, so you know who owes you money, when did they owe it to you, and LeafLink's payment tools, specifically AutoPay, make it so you actually collect that revenue because it's pre-authorized. Um, so we're centralizing like all of your payments and financial needs in one hub. And there's a few financial services pain points we're solving there, right? Like there's very high and hidden fees in Canvas banking. Most operators pay over 2,000 a month for a simple checking account. We think that's ridiculous. Like we have scaled agreements with our bank partners, with our courier partners to offer customers as low prices as possible. We want to make financing accessible. We talked a little bit about the challenges that companies have accessing capital. Through our financing partner today, we're offering 2% monthly lines of credit. Like that doesn't exist in the space. Like that's a best in class rate for most operators that are looking at like 5, 6+% monthly just to get like a working capital extension. And the last is we're getting rid of collections issues. Like as part of our payments rollout, and specifically the payments on sell-through product we have, that's kind of like consignment where you get paid as a brand once the product sells at retail. A key part of that proposition is guaranteed payments. So if you sell a product through Post, you are guaranteed to be paid for it if it sells, regardless of the retailer's credit.
Hmm.
So we have sourced insurance to specifically make it that you get paid. Like that's the first trade insurance credit like in history of cannabis. So we're really excited about it. So like overall, we are very focused on helping businesses manage the way they run their operations, simplifying all the different inputs and flows that you need in cannabis, and making that intuitive tooling directly
Hmm.
available in one platform. So we're really excited about what we're building. And we think that the new format in terms of pricing and the all access release is the best way to enable operators onto all of those different benefits. And that was what I spent a lot of my time talking through is people like to talk a lot about how we're increasing prices and like that's true. Like the average operator is going to pay more for the platform in a few months than they have historically. But at the same time, all the different values that we present to an operator is well in excess of anything that we're charging. And we think like really the first comprehensive solution that lets you simplify your tech stack from 4 to 5 different systems on the brand side, 6 to 7 different systems at retail into one system on the brand side, and maybe like 2 or 3 systems on retail. Like you have your point of sale system, LeafLink, and you can manage all your financials through us.
Got it. No, that makes total sense. And also talking about New York earlier, you mentioned how the first few years were really challenging in that market. And I think we know that in that vacuum, a lot of illegal stores opened up, in particular in Manhattan. Those have thankfully been, it looks like mostly shut down. But all that's to say, how do you feel about the dynamics from the legacy black market product, as well as the new, what's often called the gray market product from hemp derived products, and their impact on price compression in the legal markets?
That is an excellent question. Most people love to buy product close to where they live, period. I think I'm a really good example of that. I am definitely a top 1% purchaser in the industry. The top 1% of purchasers that go to retail stores in the industry make up more than 20% of sales. People who
Mm,
use the product every single day, so about
mm.
15% of total shoppers, make up more than 90% of sales. So the
Wow.
people who use the product the most are by far the largest impact on total sales and pricing in the industry. In New York specifically, you had a dynamic where you had about 30 stores across the entirety of Manhattan. I live in downtown Manhattan, and there were no legal dispensaries within a mile from me.
Mhm.
So I was someone very passionate about the legal industry. I knew all the brands. I was supporting many of our customers and going to dispensaries far away from me. Even I was susceptible to going to the bodega across the street and
Mm,
buying the California product and scanning the Metro code and making sure it was real. So it was very impactful to the legal market to have
mhm.
all of those illicit stores because it was just way more accessible. People can go to the store down the block and buy product. And not that New York City was all of the state's sales, but it was the vast majority of its cannabis sales, especially into the illicit market. So I think that tampering down all of those illegal stores has had a huge impact on the way that the legal market has been able to thrive and was definitely a necessary precursor to all the new stores coming on successfully. Where we exist today is nationally, both legal and illicit sales is about $100 billion in total. So still like about 70% of total sales are illicit. That's primarily in large medical markets and those without a legal program at all with large population centers. So like Texas, North Carolina, Florida, even like states like New York today. Um, Over time, I expect increased accessibility to the regulated legal market to start to tamper down on some of those illicit sales. This is where hemp THC becomes very important because most of like the company strategies that are selling into this like hemp market have specifically relied on beverage distribution networks in order to move product. So like the names that we always hear are companies like Total Wine and Spirits. They're doing like 5 to 10% of sales in their stores where they're allowed to stock hemp THC products
Mm.
very successfully.
Wow, that's
From hemp
crazy.
specifically. Yeah, it's huge.
Yeah.
Total floor space being dedicated to hemp THC has grown dramatically at like Total Wine. They've talked about going from like one section, so on a rack that's like one part of one aisle, they were doing like a little sliver of maybe like 10 SKUs of hemp THC beverages. There are Total Wine stores now that have hundreds of SKUs of THC beverages with an entire aisle dedicated to it. Like
Wow.
it's growing very specifically. Total Wine went on and said that more than a third of their hemp THC purchases are made by first-time consumers. So this
Uh-huh.
wider accessibility into hemp THC products has made many new consumers enter the market. I think
Mhm.
that's a huge positive for the industry. It's not impacting your daily user. It's much more impacting like new users coming in and
Mhm.
trying product. It's very intimidating to walk into a new dispensary. You don't know what brands to buy. You've never been there before. It's like just different than your typical consumer pattern. If you go to a liquor store and buy product just the same way you would buy like liquor or soft alcohol or whatever it is, you are much more likely to buy. So I think the hemp THC platform has been great at getting new consumers into the market. I don't think it's particularly impacted the regulated consumers. Like very heavy consumers like me care very specifically, at least empirically, on buying high value, high quality flour for as cheap as possible. And that's
Mm-hmm,
been one of the big drivers of price compressions in some markets. Your heaviest consumers care about buying basically the most THC per dollar that you can.
mm-hmm.
So it encourages you to sell high quantities of value flour that have very low margins, and overall reduce basket sizes if you're a store. I think many brands have focused on this hemp THC channel as a new growth area. Like we just went through earnings for most of the big MSOs, and a lot of them talked about sequentially flat performance. And I actually thought that was pretty good. Most of the big MSO markets have had intense price compression over the
Mm-hmm.
last year, especially in states like Arizona, Florida, Massachusetts, even Illinois has had some challenges. So those companies starting to diversify into that hemp channel make a lot of sense as a new growth medium. But it's still very early days in it. You've seen some partnerships, right? Like Rebel Rabbit signed with one of AB InBev's large distribution partners. They're now in 30 plus states. You have companies like Curaleaf that have converted one of their Florida stores to a hemp store
Mm-hmm.
to some success. And they're partnering with DoorDash on a lot of their like end consumer hemp THC purchases. You have Trulieve who announced their huge Total Wine partnership earlier this year. But overall, I don't think the regulated market is necessarily missing out on this growth opportunity. Like in New Jersey, for instance, there's legislation that's going to make it so that all 7,000 liquor stores in the state can sell regulated beverage products. So, like beverages sold specifically by the regulated market, not hemp THC, like real THC, which is actually the same, but like at least from legal definition purposes, it's gonna be the regulated market. So if you're a beverage manufacturer in New Jersey, would you rather sell to the 250 dispensaries or the 7,000 liquor stores? That's a huge new growth opportunity for that market. So I think overall, summarizing, hemp THC is bringing new consumers into the market. I don't think it's particularly cannibalizing regulated sales just because of the focus on that beverage format. Beverages are less than 1% of total retail sales in the
Mm-hmm.
US.
Mm-hmm.
So I don't think it's going to take away much from the regulated market, but it does make it so that most of the legal new consumers might not enter a dispensary. They might enter like a Total Wine and start buying from there. But that's not a large portion of total sales. And if
Yeah,
anything, it would just encourage new consumers to enter the market.
that makes total sense. And so, if you had a crystal ball, I mean, do you have any predictions for what type of reform we might see from the federal level in the near term? Maybe before the midterms or throughout the administration.
At LeafLink, we spend a lot of time lobbying for the industry. We're very focused on the regulated market. That's our customer base and who we advocate for. At least what we're hearing is it's very unlikely that we get a change to the Farm Bill loophole. You're probably going to have this state by state story where, like, a lot of state regulators are learning about hemp THC and are very shocked and not in a good way. Like, they're not happy. So many states are going to start tampering down on hemp THC products. You've seen it already. I think you're at 16 states that have banned it. That should grow over time, but I don't think it's going to grow very dramatically. I think hemp
Mm.
THC lives in a world where, like most people, like on both sides of the parties, like everywhere in the country, are pretty willing to accept like a legal cannabis market. They just don't want to stand one up and enforce it. So hemp THC has been that like quasi attempt to have a true legal market. And I mean, in a lot of states where you have legal hemp THC sales, like you walk into a bar and they're selling you hemp THC liquors. You go into a restaurant, you can buy like a hemp THC beverage that's canned. So I think overall it's improving a lot. And it's creating challenges to the widespread adoption of a regulated market, but I don't think it changes the path that you have for like true federal legalization. And if anything, it might encourage more comfortability with a real like legalized regulated market.
Got it. That makes sense. And then you mentioned earlier, obviously, the two large transactions you completed last year in a market where there's been very limited M&A across both plant touching and ancillary for the last several years. So I'd love to get your thoughts on how you're seeing the M&A environment shape up going forward.
Thanks, Jordan. Yeah, I think at least on the ancillary side, you're going to continue to have this bringing together of companies where you can offer all-in-one solutions. That's what customers are looking for. They don't want a civil chair across a lot of different solutions. They're really looking for like one or two platforms where they can manage their full businesses on. And that's really been the focus of most companies' M&A. Like we talk to a lot of companies in the space, and you're either trying to grow your business and continue to reach profitability and like a place where the business can be a standalone success story. But it's very hard to do that as a point solution in the space today. People want to become platforms. LeafLink's very fortunate that we are the largest platform in the space. We have the most customers, the most product sales. Like we work with everyone, and we're very happy to do it. And we think that we have about the best technology that you can get on the regulated ancillary side. So for us, it made a lot of sense for us to tie up with Dama Financial, which was the largest banking provider, to offer that all-in-one financial and commerce solution, and to partner with LeafTrade, which was the other large order management solution in the space. We had very complementary customer bases, very complementary state presences. So we were very excited about that deal, and we love the team that have come over. We love the customers that came over along with it. And overall, our goal is just continue to offer that all-in-one suite where your data moves seamlessly across all the different aspects of your platform. You can properly manage your inventory, financials, compliance, push everything into your ERP and financial systems. We're very excited about the opportunities presented through there. There has certainly been a lot of integration work on the back end of those deals to make sure they're as valuable for our customers. But we're pretty excited about what we've been able to do with those. On the plant touching side, I think if you have a change in equity pricing so that people can raise on their stock prices, everyone's going to do it and you'll have huge M&A. Until then, I think it's very unlikely you have many deals. It'll be interesting to see what happens with the huge maturity wall. I think most companies that have large outstanding maturities with the inability to refinance are probably going to go out of business or sell off those assets for pennies on the dollar. I think it's a really interesting opportunity for capital allocators that are willing to be comfortable with the plant touching space because you have facilities that were built out for like millions and millions of dollars that are going to be sold for hundreds and hundreds of thousands of dollars, a very big discount to what their actual build out price was. And most of those facilities make operational financial sense if you don't have the large debt servicing costs on them. So if you're able to renegotiate the debts, restructure the leases, and ultimately like come to a place where you have a company with the assets and without the financial liabilities, I think that makes a lot of sense and you can make a lot of money doing that. So I'm excited to see people do it. They're not doing it yet. So I think that means that most of the industry feels like there's probably more pain to come. But I think like the indication you can look out for is what happens to many of the big receiverships. You have something like Gold Flora that just entered receivership last month. They have $250 million in debt liabilities on a
Wow.
company doing very, very low volumes. So what do you do with an asset like that? Because they do have like their brand was the highest seller last month, right? So like you have the highest selling brand in receivership. It's not because the brand was performing badly. It was like the financial engineering and structuring around that. So
Right.
as you have more like financial personas come in and understand those dynamics and take many of the assets that actually can be managed profitably, even in very compressed markets, I think things will be good. But I think most capital allocation, most M&A will continue to be on like the newer markets. Like we've seen, like TerrAscend did a couple deals in Ohio. A few of the operators are buying up stores in New Jersey. New York, you're not able to yet, but there's been a lot of focus on smaller players selling out stakes, so they're able to monetize those licenses. So overall, I think you get a good amount of M&A, but I don't think things really pick up or change until equity prices.
Yeah, I agree with that for sure. Well, Ben, this has been so fun. You are just an absolute wealth of knowledge. So thank you so much for coming on the show today.
Thank you so much for having me, Jordan. I really appreciate you. Like I have watched for a long time, so I just cannot thank you enough for having me on the show. It was great.
Most definitely. Yeah, keep crushing it. And you guys are obviously staying busy on the M&A front. If folks have questions for you or are interested in signing up their brands to LeafLink's platform, is there somewhere you can direct them?
Yeah, they can go to our website, leaflink.com, and it'll be easy to go there. Please feel free to reach out to me directly, ben.burstein@leaflink.com. I promise I'll route you to the right place. I love LeafLink. I especially love the industry and the operators that work in it. It is very important to me to do right by the people who are willing to work through the trials and tribulations you get in cannabis.
Mm.
So I promise I'll take good care of you.
I love to hear it. Well, thanks again, man.
Cool. Thank you so much, Jordan.